Welcome to Breaking News to Trading Moves. Today, we are jumping right into something that happened in the software world, a moment where, the big market story really collided with what's happening on the ground.
Mm,
The focus is on the market's reaction after Snowflake put out its product revenue guidance.
right.
And for anyone who tracks these high growth data and software stocks, this was more than just about one company's share price.
Yeah.
It really kicked off an immediate a very calculated reshuffling of money across that whole part of the market.
Reallocation, yeah.
Exactly. So our mission here is to look at how that news from Snowflake, that's SNOW, affected the other players. We're going to detail where the money went, which companies benefited, and which ones lost out.
And that movement created a puzzle that a lot of investors were trying to solve right away.
Mm.
The main story in tech for a while has been that AI adoption is just accelerating like crazy.
Right, that it's unstoppable.
Exactly. And Snowflake is seen as, a core piece of that whole picture. So the question became, if AI demand is really exploding, why would a company so central to that whole thing project a moderation in its growth?
That's the disconnect.
That's the disconnect. The market had priced SNOW for perfect, spectacular growth, thinking these AI tailwinds would just lift it forever. So when the guidance hinted at any kind of slowdown, it just exposed this mismatch between the stock's valuation, what people hoped for, and the reality of what the company could deliver right now.
And that's such a key point. This wasn't just about a guidance miss. It was about a reevaluation of the whole growth story for a certain type of high-flying tech stock. We're going to name those companies by ticker and show you where money ran from and where it ran to.
Let's get into it.
All right, let's start with the event itself. What exactly did Snowflake say? I mean, what was the magnitude of this projected slowdown that caused such a sharp response?
So it all boils down to one core metric,
Hmm.
the product revenue guidance for the fourth quarter. The company said it expects product revenue growth to be somewhere around the high 20%.
High 20s. Now, on its own, that sounds pretty good.
In a vacuum, yes. For a huge software company, 28 or 29% growth is very strong. But for a company like Snowflake, it was seen as a failure. And the reason for that is all about its valuation,
The price of the stock.
the price of the stock. It's commanded this just staggering premium, a very high price to sales multiple for years. And that premium wasn't built on just solid performance. It was built on the expectation of acceleration, or at the very least maintaining growth way up in the 30 or even 40% range.
So anything less than spectacular was a problem.
Is a huge problem. That premium, that PDS multiple, it just implies that the market is willing to pay a really high price today for growth that's going to happen tomorrow.
Hmm.
So when the guidance suggested that near-term growth was taking a step down, even a small one, it broke the model that a lot of traders were using to justify owning the stock.
So they sold.
They sold. They basically said, if the growth is only in the high 20s, that premium is gone. It wasn't really a judgment on the health of the business long term, so much as a mechanical reaction to a valuation model just breaking.
Okay, that reaction makes sense now. But it does raise a question. Was this slowdown just about companies tightening their budgets, or was there something else going on? I saw some talk about an operational detail, something called a revenue smoothing factor.
Right. This is key to understanding the nuance here.
It has to do with discounts on big multi-year deals, correct? I mean, from a business perspective, locking in a huge customer for, say, 3 to 5 years seems like a great move, even if you give them a discount.
Oh, it's an A-plus strategy, operationally. Think about it from the CEO's perspective, even if they know it's going to cause some short-term accounting pain. First, it makes the customer incredibly sticky.
They're not going anywhere.
They're not going to migrate to a competitor like Databricks or one of the big cloud providers. And second, it often lowers the customer's total cost, which makes it a much easier sell for these massive projects. These discounts are really an investment in the future.
But there's a cost in the short term.
There is. The immediate cost is to the near-term recognized revenue. When you give a big discount for a multi-year deal, accounting rules usually make you recognize that revenue bit by bit over the entire contract.
So instead of a big spike in revenue now.
Exactly. Instead of that burst of growth that momentum traders love to see, the revenue gets spread out. It gets smoothed over the whole contract. And that makes the quarter-over-quarter growth numbers, the ones that show up in the earnings report, look lower.
So we have a situation where the business is doing something smart for the long run, but the technical accounting rules make the short-term numbers look slower than what the market wants from a premium stock.
You've nailed it. It's a clash between the CFO's long-term vision and the trader's short-term obsession with momentum. A trader just sees slowing pace in the headline. They don't see secured long-term revenue in the footnotes of the report. And for these high multiple stocks, that focus on quarter-to-quarter acceleration is just, it's intense.
So when that story stalls, even for a good reason, the market reacts.
It reacts aggressively. And that forced reassessment is exactly what drove the capital rotation we're about to get into. It's kind of a painful lesson in how the market punishes you. The second reality brings a little moderation into the picture.
Okay, that sets the stage perfectly. So let's trace where that capital went. When a big company like Snowflake, SNOW, valued for peak growth, slows down, the reaction is never just about that one stock.
No, it spreads.
The money that leaves has to go somewhere, or, it flees from an entire category that's seen as having similar risks. We've identified 3 clear groups that saw a negative impact here.
And it's not random. It was a very systematic process of de-risking. The market was looking for other companies that were either, too similar, too expensive, or exposed to the same kind of operational risks.
All right, let's start with category 1. High multiple AI data platforms. This one's the most obvious target, the direct peers.
Right.
Snowflake itself is the primary loser, obviously, but the fear spread pretty quickly to other high-expectation platforms in that same AI data space. Which stock felt that sympathy selling first?
The most immediate one was Palantir Technologies. That's ticker PLTR.
Okay, Palantir. The logic there seems pretty direct.
It's very straightforward. I mean, investors see PLTR as this crucial proprietary AI data and analytics platform. The whole investment case for Palantir really depends on 2 big things. 1, super fast growth in their commercial business.
And 2.
And 2, the ability to monetize their special platforms like AIP really quickly and efficiently.
So the fear wasn't about Palantir's technology, but more about the difficulty of turning that tech into revenue fast enough in the corporate world.
Precisely. Snowflake's experience suggested that even when you have massive data workloads and clear AI demand, the whole enterprise sales cycle is complicated. You've got deal structuring, customers scrutinizing every penny of their usage. All of that slows down how fast that revenue actually shows up on your income statement.
So traders started asking if SNOW is facing this.
What does this mean for PLTR?
Exactly.
Palantir also trades at a very high multiple, which reflects this belief that its unique tools will just translate into immediate, accelerating revenue.
So the Snowflake news was a bit of a reality check.
It was a big reality check. It was a warning signal that even the best AI data platforms face real friction in tuning customer interest into those smooth quarterly earnings beats. So investors who were just betting on that pure momentum story in PLTR, they cooled off, and capital pulled back, even though there was no bad news from Palantir itself.
It was purely a risk reduction move.
Purely. Just based on being in the same neighborhood as the Snowflake story, it was the market just widening its definition of risk for that whole class of premium-priced AI promises.
Okay, so that's the direct peers. Now let's move beyond that into the second category, which is about more generalized de-risking. This is where the selling is defined less by similar products and more by similar valuation profiles. We're talking about expensive software as a service or SaaS momentum names.
This is what traders often call basket selling. Or you might hear the term multiples compression risk. Investors tend to group stocks into these baskets based on shared traits. In this case, the trait was high-quality growth trading at a massive premium.
So when one of them stumbles.
When a leader in that basket like SNOW stumbles, the whole premise of the basket gets questioned. The idea that high growth can justify any price that comes under fire, and the whole group becomes vulnerable.
So which companies, which weren't even in the data warehousing space, got hit because of this general valuation fear?
The analysis points to 2 big cybersecurity players, CrowdStrike, ticker CRWD, and Zscaler, ticker ZS.
Okay, CrowdStrike and Zscaler, that's a really important distinction for you to note because their business is security, not Snowflake's data business.
Totally different worlds, product-wise. But what they share is that they are both highly valued, high-growth software companies. They're leaders in their field's endpoint security for CRWD, zero trust networking for ZS. And because of that, they trade at these premium multiples, often double or triple the price-to-sales ratio of other software companies.
So the moment the Snowflake news hit, investors got nervous about all high valuations.
They got hypersensitive to it. The thought process was immediate. If the leader in the data space can't hold its multiple, How safe are the multiples on other momentum leaders like CRWD and ZS?
And the market didn't wait to find out.
No, they didn't take time to analyze their individual sales pipelines. They just saw high multiple software, recognized the risk that multiples across the whole sector could come down, and they pulled capital out to lower their exposure.
So it was a systematic flight from valuation risks.
Exactly. That's what drove the selling pressure on CrowdStrike and Zscaler.
That makes the mechanics really clear. Category 1, Palantir C, suffered from a kind of operational similarity fear. And Category 2, CrowdStrike and Zscaler, suffered purely from a financial similarity fear.
That's a perfect way to put it.
Okay, so that brings us to the third category of losers. This group got hit because of a very specific detail in Snowflake's update, something related to their core revenue model.
Yeah.
Snowflake's comments about deal structures and customers optimizing their spend was a blunt reminder that usage-based revenue can be, well, volatile.
It really laid bare the vulnerability of that consumption model. I mean, that model is super popular because it seemed to promise almost unlimited upside, right? The more a customer uses your platform, the more money you make.
It's seen as better than a fixed subscription in a growth market.
In a growth market, yes. But as Snowflake pointed out, customers are getting better at managing their spending. This process is called optimization. And that's where the market was reminded that this model, it cuts both ways.
Explain that. What does optimization look like for a customer?
Well, when a big company really starts using a cloud service, they get smarter over time. They learn how to monitor their usage, they figure out how to eliminate waste, and they negotiate harder for volume discounts.
Got it.
And for any company whose revenue is tied directly to usage, this customer optimization can slow growth down unexpectedly. It makes their quarterly results lumpy and unpredictable, which is the exact opposite of what growth investors want to see.
So which companies that use a consumption model were reassessed because of this fear?
We saw immediate negative pressure on Cloudflare, that's ticker NET, and Okta, OKTA.
Okay, Cloudflare and Okta.
Cloudflare's revenue is heavily based on consumption. Things like bandwidth, the number of requests, usage of their edge computing services. And Okta, while it looks like a subscription, has parts of its business where revenue is tied to usage, like the number of transactions or certain advanced features.
So after the SNOW update, investors started to worry about the predictability of their growth too.
Exactly. The thinking was, if Snowflake's really engaged, data-heavy customers are working hard to optimize their spending, there's a good chance that Cloudflare's and Okta's customers are doing the same thing.
Which introduces that volatility risk.
The lumpiness factor. And that alone is enough to make traders who are chasing stable momentum pull their capital out and look for safer options, maybe favoring those old-school fixed subscription models for a while.
So to just quickly summarize the losers, Palantir got hit because of platform similarity, CrowdStrike and Zscaler because of valuation similarity, and Cloudflare and Okta because of their business model similarity. That's a very systematic process.
It is. And it shows that in high-growth tech, the market doesn't just look at a company on its own. It looks at its proximity to any kind of perceived problem, whether it's a valuation issue or an operational one.
All right, so that's where the money fled from. Now we have to talk about where that capital ended up.
Yes, and this is crucial. The market's reaction was not a rejection of the bigger trend. The story that data is exploding and AI needs massive computing power. That story is completely fine.
So what was rejected?
What was rejected was the specific valuation of Snowflake in the near term. And that realization made capital flow immediately into other sectors and other companies that were seen as, better positioned, more immune, or just more fairly valued to capture that same growth.
So the winners weren't defensive stocks. They were strategic choices based on a different value proposition.
That's right.
Let's get into the three categories that benefited from this rotation. First up, the cloud hyperscalers and AI infrastructure. This group benefited because Snowflake's own numbers, even with the slower guidance, actually confirm in the market's core belief that enterprise AI workloads are getting heavier and require way more underlying computing power.
This is the classic picks and shovels trade. Snowflake might be dealing with some choppy revenue recognition, but what does Snowflake run on? It runs on the cloud infrastructure from the big hyperscalers.
Right.
And the sheer scale of the data being processed, especially with these new heavy AI workloads that Snowflake even mentioned, like its partnership with Anthropic, that translates directly into more demand for compute, storage, and networking.
And who are the main beneficiaries of that tailwind? The ones who are basically immune to Snowflake's discounting strategy.
The primary winners here were Microsoft, ticker MSFT, and Amazon AMZN,
The two giants.
the two giants.
Yeah.
The growth in data and AI processing just confirmed that their cloud businesses, Azure for Microsoft and Amazon Web Services, AWS for Amazon, are the essential base layers. They make money from the volume of data being processed, no matter how a software vendor like Snowflake decides to book the revenue on top of that infrastructure.
Okay, I get the structural logic, but let me challenge that a little. Cloud margins have been under some pressure lately because of customer optimization and competition. Are we sure this rotation into MSFT and AMZN was a strategic move into high-margin AI, or was it just a defensive place to park cash that was fleeing risky software stocks?
That's a very fair point, and the nuance here really matters. While general cloud margins have faced some pressure, the rotation here was specifically driven by the premium nature of AI workloads. Generative AI, machine learning training. These things require enormous amounts of specialized hardware GPUs, custom chips, and these services, especially the ones offered through platforms like Azure AI or AWS Bedrock, they usually carry much higher margins than standard cloud storage or compute.
I see.
The Snowflake news, especially with the mention of the Anthropic partnership, signaled that the demand for these premium AI-specific services is speeding up. So capital rotated into Microsoft and Amazon because they own the supply chain for this high-margin AI infrastructure.
They're capturing the spending at the base layer.
They're capturing it at the fundamental base layer, which makes them the safest bet on that data explosion trend continuing. So yes, it was a strategic flow betting specifically on the higher-margin AI part of their cloud businesses.
Okay, that clarifies that. Let's move to the second category of winners. This one seems to be based on a pretty straightforward principle. When a leader disappoints, capital looks for peers who have recently done better.
Exactly. It's a flight to perceived quality, but within the same tech sector. Traders still want exposure to the underlying theme data, AI, observability, because they believe in it. They just don't want the risk that now comes with Snowflake's phi multiple and its guidance.
So they're looking for the next best option.
The next best option that's shown recent strength and doesn't have that overhang of a growth scare.
So which companies in related data fields were seen as executing better and managed to capture that rotating capital?
The market really favored two names here: Datadog, ticker DDOG, and MongoDB, MDB. Both of them had recently put out results that the market saw as having a much cleaner story than the mixed message from Snowflake.
Okay, let's take Datadog, DDOG first. They're in observability, right? Helping companies monitor their cloud stuff.
That's right. And while they also have a consumption-based component to their model, their focus on consolidating all these monitoring tools into a single platform has given them a very sticky, defensible business. Their recent guidance had been more stable, which suggested they were either managing customer optimization better or that their product provides such immediate value that customers just aren't cutting back on it. So the capital flowing out of SNOW saw DDOG as a high-quality growth company that was managing the current environment really well.
And MongoDB, MDB, is a different kind of product. It's a database platform. Why did that one also benefit?
Right. MDB offers a modern, flexible database that's critical for building new applications, especially ones that use a lot of data and AI. Their growth story has been consistently strong, tied to companies moving away from old legacy databases.
And their recent quarter was good.
Their recent quarters had been robust. They had a really clear execution story. So for a trader who wanted to stay invested in the data management theme but was nervous about Snowflake-specific issues, MDB offered this attractive, proven alternative with a cleaner recent track record.
So the relative strength of their performance just acted like a magnet.
It absolutely did. It suggested to investors that they had more confidence in MongoDB's ability to turn that enterprise demand into smooth, predictable quarterly revenue.
Okay, that makes sense. Which brings us to our final category of winners. This one seems to be about the investor mindset. They still believe in the long-term data and AI story.
Right.
But they're suddenly very nervous about paying ultra-high valuations after what happened with Snowflake. So they start looking for value within growth.
This represents a shift towards being more conscious of valuation. Investors aren't giving up on growth, but they're applying a much stricter filter. They're looking for exposure to the engine of growth, but at a more reasonable price.
Because the downside is bigger on a more expensive stock.
Exactly. They recognize that if growth is going to slow down across the sector, the risk on a stock trading at, say, 20 times sales is way bigger than on a stock that's trading at 8 or 10 times sales.
So which companies in the data infrastructure world were seen as providing that growth exposure at a more palatable valuation?
The winners here were Confluent, ticker CFLT, and Elastic, ESTC.
Confluent and Elastic.
Both are foundational pieces of a modern data ecosystem. Confluent, CFLT, is the company behind Apache Kafka. They specialize in real-time data streaming. That's the vital pipeline moving data between systems instantly.
And Elastic.
Elastic, ESTC, provides powerful search and analytics tools. They're often crucial for taking all that data and turning it into something a business can actually use right away.
And the key here is that they're cheaper valuation-wise than Snowflake.
Much more modest multiples. I mean, just as an example, if Snowflake was trading at 18 times forward sales, these companies might be in the range of 8 to 12 times. They're still growing fast, their tech is essential for AI and data, but the entry price isn't nearly as punishing.
So they were seen as a safer way to play the same trend. Capital moved out of the ultra-premium names and straight into these lower multiple ones.
That's it. Investors believed the growth story was still there, but the pricing needed a correction. So CFLT and ESTC became these immediate magnets for those valuation-sensitive investors. It gave them a way to stay exposed to the data growth trend without the huge overhead and downside risk of a stock like SNOW. It just underscores how the market rediscovers its respect for value when growth shows any sign of faltering.
That's a great summary of the whole rotation.
So to kind of bring this all together, that Snowflake guidance event wasn't really a destroyer of the data or AI trend. It acted more like a crucial market mechanism to enforce some discipline.
Right, a rebalancing.
Rebalancing. It showed the market's extreme sensitivity to growth expectations in this space and how even a pretty modest change in guidance can cause this major sector-wide capital reallocation. It's a really powerful example of how relative valuation and perceived operational flaws can drive where the money flows.
And that really is the essential lesson for you as you're tracking these movements. The volatility we saw was less about the long-term failure of AI or data, and much more about the very delicate balance needed to justify an ultra-high valuation. Understanding these category-specific rotations, why Cloudflare, NET, and Okta, OKTA, got hurt alongside Snowflake because of a shared business model risk, while Microsoft, MSFT, and Amazon, AMZN, benefited from being structurally immune, that gives you the necessary perspective.
Yeah.
This knowledge lets you better anticipate where capital might flow next time a market leader in a high-growth sector hits a speed bump. It gives you a much fuller picture beyond just a single stock's price change.
Absolutely.
Please remember, this conversation is based purely on market observation and analysis of the information provided. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thank you for joining us for Breaking News to Trading Moves. We'll talk to you next time.